Welcome to the Daily Briefing. It's Monday, January 11th. Soon, I'm going to be joined by Real Vision Managing Editor Ed Harrison. But first, with the day's stories, Haley Draznin.
Hey Jack, market sentiment is dim on Monday. It's a modest reversal after last week's strong start to 2021 for equities. Investors are confronting a number of both political and regulatory risks. To start, Twitter fell after the social media platform permanently banned President Trump's account after last week's insurrection of the Capitol. This shows the company is making editorial decisions and opens the door to more regulation of social media under the Biden administration. Shares of Facebook, which also suspended Trump's account, also declined, and House Speaker Nancy Pelosi on the political front announced that the House may move to impeach President Trump as soon as this week. That's if Vice President Pence does not choose to invoke the 25th Amendment. Stimulus efforts might be slowed as a result of this, and last week's rise in the markets was really attributed on bets that the Biden administration would push another round of aid under the Democratic-controlled Congress. We saw the dollar up Monday, which has been lifted since U.S. Treasury yields rose last week. Again, this was on bets that the Democratic-controlled Congress would mean more stimulus for the U.S. economy, feeding into inflation and an uptick in economic growth. With the 10-year Treasury note yield logging its largest weekly rise since June, the move in yields could prompt investors to really rethink 2021 strategies. Yields, which move in the opposite direction of bond prices, edged a bit higher on Monday. It's interesting, with the dollar up, Bitcoin is seeing its first major correction of 2021, selling off over 25% from its high of nearly 42,000 at the end of last week. As major institutions seem to be increasing their appetite for the flagship cryptocurrency, they really need the banks open in order to allocate capital into this market. It could be important to pay closer attention to how Bitcoin trades during the week versus on the weekends when the banks are closed. Time will only tell if the crypto market finds this near-term support. And, in the near term, speaking of, there's a very real and present danger that the U.S. could double dip in the first quarter. We saw the first signs of that with Friday's jobs report. There were 140,000 job cuts in December, and a shocking gender gap was revealed. Women accounted for all of those job losses, losing 156,000 jobs, while men gained 16,000. This, of course, signals the U.S. economy is backtracking. Bottom line, it feels like 2020 hasn't really ended. We're in the middle of a pandemic still, and we're continuing to talk about U.S. politics, maybe now more than before. The underlying story is still pretty much the same. Back to you, Jack.
Thanks, Haley. Welcome, Ed.
Yeah, good to talk to you as usual, Jack.
Yeah, great to have you on the Daily Briefing and great to be here. Ed, so what did you make of today's market action? We had stocks down, all three major indices down. The bond market was, yields actually increased a little bit, which is confounding. And then we had a big, massive sell-off in crypto. What do you make of that today?
Yeah, actually, I would almost say it's not confounding when yields go up. Finally, equities, they're reacting to that. But the big moves are gold on Friday, and then now we have crypto selling off. To be honest with you, I feel like markets have been overheated, and really, there's no news. I saw what David Rosenberg was writing. He was like, interestingly, you get bad news from the ADP, and you get bad news from the Labor Department, but markets are up. And then on no news over the weekend, we get the markets down. So who knows what's driving them in the short term? But from my perspective, it's good to take a breather because markets have been overheated to the upside, and that makes the potential for an air pocket of significant measure much greater.
Right. So you said that markets are getting a little bit overheated. We've got a chart here, which is the price to sales ratio of the three major indices going back all to 2000. And it now is the case that the price to sales ratio, meaning the market capitalization relative to the amount of revenue of these companies that are in the indices, are at all-time highs. So needless to say, Ed, to use one of your favorite words, things are getting a little bit bubblicious. What's your take on that?
Yeah, I think that all-time highs for price to sales makes a lot of sense to think about that as being bubblicious, because obviously the only way that that works is if you're thinking profit margins are going to increase. And we know that profit margins had increased and they've remained relatively elevated at a minimum from a non-GAAP perspective. And so the potential that they could go even higher, especially during a pandemic, is limited. So I think record price to sales is a sign that things are at a high level. I mean, you could try to say, "Hey, look, it's the DCF, stupid," meaning that when the rates go. And by the way, I got this from Holger Shapitz. That's a great little line. It's the DCF, stupid. We can go into that a little bit. But when bond yields are so low, then you can get away with that.
Yeah, Ed, that's a really interesting chart for all those who are listening to this as a podcast. On the left axis, we have the FANG index shooting up from July 2020 to now. And we also have the US 10-year yields shooting up as well. They mirror each other pretty closely. And Ed, this actually surprised me because the typical logic is that as yields decrease, that makes it more attractive to own companies whose cash flows are well into the future, such as the ones in the FANG. So therefore, I would expect it to have a little bit of a V rather than have these charts sort of follow each other so closely.
Yeah, it is amazing. I think what it boils down to is that there's something amiss. So when Holger Shapitz says it's the DCF stupid, and you see a chart where 10-year yields are rising and stocks are rising, especially stocks that have supposedly profits into the future, you do wonder what's going on there. So to me, this is a sign that we don't have all the answers, because I agree with you, Jack. It should be the opposite.
Right. And just connecting this to what you said earlier, I said the bond market action was confounding. You said, not so fast, Jack. And this kind of goes through, there are two opposing forces, because when the bond market sells off and yields rise, that means that there's liquidity that was in the bond market and now it's out of the bond market. Where's it going to go? Most likely, a good portion of it is going to go into the stock market. So that's, typical. When bonds yields rise, you have stocks rise with them. But on a longer term chart, you'd expect there to be a more structural effect of investors saying, "Hey, yields are so high. I'm going to go buy bonds and then sell the FANG." Or yields are so low, I'm going to park my money out of bonds and put them into companies whose cash flows are projected well into the future. Would you agree with what I just said? How there are these sort of two different forces that oppose each other? And if so, what do you make of them?
Yeah, it is interesting. You're talking about, in effect, a rotation play between assets. Like when you talk about the 60-40, the 60-40 moving to a 65-35 or a 55-45 ratio, so that money moving out of one market is going into the other, and that's what's impacting. So when bonds sell off, and meaning yields go up, then also equities should go up at the same time. That's what we are seeing with this FANG stock. But over the longer term, when bond yields rise, the discount rate rises. So when Holger Shapitz writes, it's the DCF stupid, what he's saying is the discounted cash flows of companies that have a lot of their cash flows with 5 or 10 years out, then you're looking at the net present value of those cash flows being diminished when those bond yields rise. So the DCF is getting worse when bond yields go up. So I would think, everything else being equal, over time, that's a headwind for stocks.
Right. And Ed, just for the folks at home, could you quickly explain what you mean when you say companies that have cash flows well into the future? And just to pick two companies that are at the polar end of the spectrum, let's say Tesla versus a mining company. What are the different...
Berkshire Hathaway, because
Berkshire
there
Hathaway,
was a
perfect.
point. So yeah, I think if you look at those two companies, Berkshire and you look at Tesla, Berkshire basically, if they're making tons of money today, and in 2021, they're making a ton of money. They're going to make it in 2022 and then 2023. And relatively speaking, not that much more in 2028. So from a discounted cash flow perspective, much more of the money that they're making is in the here and now relative to the future. But then you look at a Tesla as an example, they're not really making a whole lot of money at all relative to their market capitalization. Both Tesla and Berkshire have about the same market capitalization. So really, in order to justify that market capitalization, all of the cash flows that need to be discounted to the present are way into the future. That's when they're going to make much, much more money according to the discounted cash flow model that they have. And that money has to be discounted back to the future to put it in net present value terms. So obviously, the higher the discount factor is, the worse those cash flows look. So if money is low, that is, if interest rates are low, then that's good. But when interest rates go up, then the discounted cash flows go down.
Right. I think that's a great explanation. Thanks, Ed. And just talking about interest rates going up, we look at a chart of the U.S. 10-year Treasury real rate, so that's adjusting for inflation. And since the beginning of the new year, it has inched up. It's now higher than -1. And you look at the U.S. dollar index, and it's closely matched onto there. What do you make of number one, nominal yields rising, and then number two, what happens if that real rate rises as well?
I think that this is where the gold comes into play more than anything else, because there's a term that people used to use a lot called financial repression. And that's this term that started when QE was big in the first great financial crisis, that last recession that we had when QE was first being used, that when you're suppressing yields, you're creating so-called financial repression by making it so that people can't earn any money. And that means negative real yields. That means that after inflation, I'm not making any money. Actually, I'm losing money. And that is what people think of when they think of financial repression. When you look at owning gold, which isn't earning any yield, the penalty of owning gold, which you have to store, there's a cost associated with that, and then that you're not earning any interest on that. The penalty isn't there. In fact, it's actually to your benefit relative to interest rates, where you're losing money after inflation to own gold. And so that makes gold and other precious metals interesting in those cases. But when your real yields are starting to rise, then gold is, relatively speaking, less attractive, because the financial repression has decreased, and that therefore the advantage you have of holding gold goes away.
That's very interesting. Ed, would you say that's true about most commodities, since they have a negative carry, so to speak? In other words, if I chop down lumber and I have lumber in my backyard, I'm not getting any yield on my lumber until I sell it. I mean, it's not yield. It's capital appreciation. It's the price. But it does cost money. I do have to, say, buy a little rack to store the wood. In the case of ExxonMobil, you have to pay companies like Scorpio Tankers to store your oil. That's why we had the problem, last year in April, when the price of storage was greater than the price of the oil itself. So the price of oil dipped. Ed, would you say that what you said about gold, would that be true about all commodities more broadly?
I think, yeah, it is true, but all of the dynamics that you were talking to make a lot of sense in terms of the supply and demand. The supply and demand of gold certainly is there. People talk about that with, the need for jewelry in places like India and places like that. And when you talk about silver, you're talking about the industrial use of silver as well. But ultimately, gold is a store of value. People think of it as money. And so therefore, these monetary aspects are much more important than they are in commodities, where the commodities are being used and there's a supply and demand element associated with them. And that's the thing that is really the biggest driver.
Right. Ed, gold has been thought of as a hedge against inflation, or a hedge against currency depreciation. Over the past year, we've seen that Bitcoin has become all too common when discussing things like hedges against inflation. And people say, oh, I want to sell my gold. I want to own Bitcoin. Obviously, Bitcoin has been on a tremendous tear over the past year. But today we had a mighty sell-off. At one point, it was down. I saw 22%. It has had a little bit of a rally. It's now only down 9% at about the $34,000 level. Ethereum has followed suit. I haven't followed the other cryptos, but I assume that they are. They generally are extremely correlated to each other in my experience. What do you make of the sell-off in Bitcoin and Ethereum today?
Yeah, I thought it was pretty interesting, in the sense that Bitcoin's supposed to be an uncorrelated asset. And by the way, before I even start talking about this, let me just give a shout out to you and Max, because I know for a fact that you and Max are going to be doing the RVDB next week on Monday, because that's Martin Luther King Jr. The holiday, and we're going to be closed, and you're going to do an AMA, if I'm right, and you're actually going to be talking about Bitcoin, because the two of you are a little different in terms of how you think about crypto.
Yes, I'd say that's right. Yeah.
Yeah. So you're doing the AMA. You're taping it sometime later this week, and you guys have a different opinion. I mean, my opinion on the whole Bitcoin phenomenon is that it's supposed to be an uncorrelated asset. It's a hedge against fiat currency more broadly, but it's not a guarantee to insta wealth. What concerns me is that when you have Tesla going up like 8 times and Bitcoin going up 4 times in the same year, you're at a point in the economic cycle in the financial markets where that uncorrelation has diminished, where actually it's the reason that you own Tesla is exactly the opposite reason that you own Bitcoin. You own Bitcoin because bad things are going to happen, and fiat currency, you need a hedge against it. You own Tesla because you think that everything is hunky dory and Tesla's going to benefit, and you want to get in there. When those two are going up together, that tells you that you are in a place where Bitcoin is not uncorrelated, and that concerns me.
Ed, I think that is such a good point. Now, I, perhaps unlike you, am someone who believes that Bitcoin does have a place in your portfolio, a relatively small place based on its volatility. But I believe that it does have an attractive risk reward profile. If you just look at its history, as Mike Green said, and Mike is the ultimate Bitcoin skeptic, he said, "I've never doubted its ability to go up." Now, do I believe the sort of lofty claims of people who think that it's going to become a global reserve asset? Probably not. I think that it's, the most likely outcome is that it goes down a tremendous amount. But I think that in the a rare option in which it does, I think it will go on such a tear that it's basically an asymmetric bet. So it will have the payout relative to it would be long volatility. However, that doesn't mean that it's going to have the same correlations that other long volatility bets will have. For example, the S&P 500, the exact opposite bet of the S&P 500 is going short the S&P 500, or another version of that is buying a put option. If the S&P goes up, your put option decreases in value, unless implied volatility spikes, which happened in March. But if it goes down, you make money. So that is essentially lockstep. Pretty much, it's pretty close. I think the claim that Bitcoin is not correlated to other financial assets, I too have a little bit of doubt with that. One thing I don't have a doubt about is that all the cryptos trade remarkably similar to each other. If Bitcoin's down 10% and you look at the other ones in market caps, you're going to be seeing a lot of red. Maybe one green here, but you're going to be seeing a lot of red. And we actually have a chart here of the one-day return of Bitcoin versus the one-day return of gold. Bitcoin is in the red. So today it was down 20%. That was the worst sell-off we've seen since March. Again, I made this chart about 2 to 3 hours earlier. It is now only down 9%, although Ethereum remains down 20%. So as you can see, it trades somewhat similar to gold in that it's an inflation hedge, but it's just the peaks and valleys are just magnified so much. So Ed, sorry, I know I've been talking for so long, but my brother actually asked me if he should buy Bitcoin the other day, and I told him no because he's, that if that would be his first investment of his life, and I don't think he's ready for that level of volatility. However, I think that people who are prepared to accept the risk, I think it will have a favorable risk reward profile.
You just wanted to keep all the gains to yourself. You wanted to keep them out.
Yeah, pretty much.
What I would say is actually, people like your brother, I do have a certain degree of fear of them entering the market at the bubble stages of the market. That's where you see valuations that are unjustified in equities, and then going into Bitcoin and with the same sort of mentality. That's not the atmosphere for Bitcoin to do well in, and for the volatility to dampen. Bitcoin's volatility actually had been coming down over a period of time, only to reawaken as a result of the speculative mania that you see in shares, spilling over into Bitcoin. But eventually, when the bubble bursts, the question is where will Bitcoin be after that happens? A year later, 2 years later. That's really when we'll know more about cryptocurrencies in general, because that's when it'll be completely divorced from the speculation that's going on in other financial assets.
Yeah, I may add that what Raoul has said about the institutional wall of money has largely come true. We've seen not just MicroStrategy, but Anthony Scaramucci's fund. JP Morgan wants to, Wash Mutual. That wall of money has come, and guess what? The only Bitcoin that they can buy is from the Grayscale Bitcoin Trust, and that's why the Grayscale Bitcoin Trust often trades at such a premium, sometimes as high as 30-40%, which is very rare for ETFs, to the underlying price of Bitcoin. I think one consequence of the institutional wall of money coming in is now that they're subject to the volatility of financial markets. There didn't used to be contagion. Google was down 12% today. Who cares? Because Bitcoin is all owned by retail. They don't really own Google. The price of a share is $1,700. It's not really correlated. But now it's owned by Anthony Scaramucci's fund. He allocates to other funds. They own Google. That's going to have a difference. That's going to make an impact.
Yeah, it's very interesting. I mean, correlations go up at various times, and for me, the bottom line for this whole conversation is that as you move towards price movements that are 2 and 3 standard deviations along the curve, of possible outcomes, you get more and more into the area where people are just like, oh, you know what? It pays to speculate in this other asset class as well. And so those correlations start to tend to cluster. And that's where we are right now.
Yeah. Ed, we're nearing to a close. So I was going to ask you, what are your sort of trades that you have on your horizon? I'm going to gather it's not going to be Bitcoin. So if it's not Bitcoin, what do you have your eye on?
Yeah, I mean, I'm a bond market kind of guy, so I'm watching. And I'm not going to say I'm not going to give you any trades per se, but I'm watching 2 or 3 different things. One, I'm watching tips versus normal treasuries. I think that that's an interesting gauge in terms of understanding where sentiment is in terms of inflation and inflation expectations. I'm looking at the actual, level of treasuries. I think it is interesting that we hit 110 today, and the question is how much further can we go up before people start crying it's the DCF stupid? I think that chart that you saw, where you saw Apple and the FANG stocks all going up together with yields, if that breaks down, that correlation goes away at some point in time. We knew that it was like 3% back during the tantrum that we had in 2018. How much is it going to be now? Is it 1.5%? It's not far away from where we are now. I don't think we can go that much higher. And then the last one, of course, is investment grade versus high yield. To me, the rubber hits the road in those three areas. One is the absolute level of yield. Two is inflation adjusted yields versus nominal yields, and three is investment grade versus high yield. Those are the three areas that I'm looking at.
Interesting. Ed, can I get your take on investment grade versus high yield, where you sort of fall out on? Because I definitely have my own thoughts. What are you thinking there?
Yeah, I think that when we talk about the look through on equities, we're going to see it first and foremost in terms of high yield versus investment grade, meaning that if you look at it, bankruptcies have been relatively low. I've seen figures that say that bankruptcies this year have been much lower than anticipated. And so the question is if we get this this wave that we're going through now becoming worse, and we have a lockdown, is it going to get worse in terms of bankruptcies, or are we going to be able to look through this period to the post-vaccine period, and therefore it pays to stay in high yield because of the excess return? So that's what I'm thinking, that high yield wins in a case where you can reasonably look through to the other side. If you can't look through to the other side, it's going to be a credit event, and high yield will suffer, and it will suffer at the same time or before equity suffer, because that's when the defaults will start happening.
Yeah, that's such a good point. I think there's an opportunity in long quality equities and short high yield. I didn't look at credit spreads today, but high yield spreads are just so low. And it's not that I'm, as an investor, unwilling to lend to the high yield market and unwilling to take those risks. It's just that 4%, 5%. Like if I invested in the high yield bond market and I win and I get 5%, I could barely buy the balloons to throw a party to celebrate. It's just not enough for me, 5%.
But at the same time, the question is how much volatility are we going to see in those yields going forward with the Fed intervening, with fiscal policy potentially levitating the ability of the economy to make it through. I'm open to the concepts that we're not going to see another hiccup the way that we saw in March 2020. But generally speaking, I'm on the other side of that. So I would agree with you, but I'm open to the concept that it doesn't happen that way, that we actually do have we get to the other side without any sort of volatility.
I think it's possible. The Federal Reserve's track record in suppressing volatility and boosting asset prices is impeccable over the past year. So you could be right, Ed.
Unfortunately.
All right. Well, thanks so much, Ed. It's been a pleasure as always.
Yeah, I love talking to you, Jack. It's been great.
It's been great. Thanks.